Okay, great. Let's get started. Good day, everyone. Thank you for joining. This is our first webinar we've done specifically on digital agencies. We've done these types of webinars for e-commerce brands for several years now. And over the last 6 months, we've done on SaaS businesses, and we're delighted to start doing these now on a semi-annual basis for digital agencies. So the structure of today's webinar is briefly, I'll introduce you to the Fortia Group. A lot of you are new to the Fortia Group. I'll give you background about what we do. We'll then walk through our semi-annual report with my super list of co-speakers, and then we'll have lots of time for Q&A. From a housekeeping perspective, please submit questions as we go. Please use the Q&A functionality on Zoom, not the chat tab. They won't be answered. The Q&A tab makes it so much easier to chair. Our speakers today will also answer the questions that you pose as we go. They can type answers, and the most interesting questions we'll discuss live at the end. The recordings of all of our webinars for brands, for SaaS companies, for agencies are available on our YouTube channel. Just type the Fortia Group into YouTube to see those. And this recording and the deck will be circulated by the end of the week. Okay, so briefly, just want to introduce you all to the Fortia Group. We started in the e-commerce sector 5 years ago. And more recently, then we've expanded our sector coverage to focus on 4 areas. First is AI and data. Second is agencies. Third is e-commerce brands. And the fourth is SaaS. And frankly, the reason why we've chosen those sectors is because one of the 3 co-founders of the firm has operational experience in those. So, for example, I have an AI and data business. My co-founder, Paul, worked at a digital agency, is a shareholder in an e-commerce brand, and David, who you'll hear from today, was CFO of a SaaS business. So we genuinely have operational experience in those businesses as opposed to being, geeky financial M&A guys. And that's really important when you want to understand the business, but B, articulate the business in a sim and a virtual data room, and really explain the growth story, etc., which is key to getting a good valuation. So there are the sectors. We are, excuse me, let me just go back for a second. We're in the lower middle market. So I used to work at Morgan Stanley. That's obviously the upper market, the sort of the top biggest deals on Wall Street. You have then firms like Stifel, Houlihan Lokey, and others doing what we would call the upper middle market deals in the 200 to 500 million range. We're the lower middle market, which is doing deals worth $10 million to $200 million. Below that, we call it the micro market. Deal size is sort of below 5 million, and there are different types, more technology, database-led businesses solving for that. It's less about the human touch or experienced Wall Street M&A folks. And so that's where we're positioned, and they're the sectors that we cover. The 2 points I want to mention, one for sellers and one for buyers. For the seller's perspective, we are huge believers in focusing in on exit readiness. And this is something that Carrie, I know, we'll talk about later on. Too many entrepreneurs leave it to the last minute, which basically means then they leave money on the table because they haven't got all their ducks in a row. When I was at Morgan Stanley, firms were preparing for exits 1 to 2 years out. So I'd like to encourage any entrepreneur that wants to exit to be thinking as early as possible and be following a sort of a flirt, date, marry approach to ultimately finding the right partner for your business. That's on the seller perspective. On the buyer perspective, one thing we did really well in the e-commerce sector over the last few years is create a community of acquirers on a WhatsApp group. We have nearly 150 e-commerce acquirers in a WhatsApp group, and we're going to do the same in this space in digital agencies. So for those acquirers on the call, either live or listening to the recording, if you can prove that you're an acquirer, please reach out to me direct, and we can get you into that community when it launches, probably in June. So that's all I want to say on the Fortia Group. Welcome, everybody. So let's jump into the heart of the discussion, which is the report. So we have 6 speakers today. Myself, my background, as I've said, is Wall Street. I've done over $20 billion worth of deals since the year 2000 when I started investment banking. So that's what I bring to the table. Chris, who you'll hear from later on, has a lot of experience on Amazon agencies in terms of valuations and matchmaking with buyers. Tom has had an acquirer in the e-commerce space. He's now got a firm called Ava doing deals in the agency space. Tom will give an interesting talk about what he's seeing. C Walk from Barrel Holdings is an active acquirer of agencies. So he'll give his thoughts on what type of investment criteria he has. Delighted that Carrie can join from the Whisper Group. Carrie has built one of the first agencies and exited successfully, and is helping particularly female entrepreneurs get ultimately to successful exits. My colleague Paul can't make it. Paul worked at an agency. Unfortunately, he's sick today, so he can't make it. So he'll be substituted by one of my other co-founders, David. So that's the lineup we have for you today. So let's just jump in. First of all, I want to tell you about how we think about structuring these type of reports. We don't just jump straight to EBITDA multiples. That's too short-sighted. There's so many things that go into, so many ingredients that are factors that go into ultimately thinking about what a valuation is or what a range should be. And it starts very much macro, then goes to sector, then goes micro. So at a macro level, like global M&A activity is absolutely key. If there's loads of global M&A activity in lots of sectors happening, there's more likely to be M&A in the agency sector. Then it sounds obvious, but we need to be looking at the data points. Two is agency trends. What are the current trends for agencies? Is it a good place to be? Is it an up market? Is it a down market? And Chris will talk to that specifically for Amazon agencies. It's important to keep an eye on public market comps. They can have it can be a proxy for private valuations, excuse me. Obviously the public market comps in this space are giants, and there's not that many of them, but however, we'll just look at them briefly to as a barometer. Then we'll jump into the activity of M&A in digital agencies. We'll hear from Tom, we'll hear from Seawalk and what they're seeing. We'll talk about brand metrics. What are the metrics, the agency metrics, excuse me, that the acquirers want to see? And Carrie will then talk us through some of the deal dynamics that she's seen in deals. And then I'll finish up with lots of data points on valuation and ultimately the range that we see today. Okay, so section one, global M&A activity. Here's the hard truth as to where we are today. The Q1 volumes of deals in terms of deal count, not dollar volume, was the lowest in the last 20 years. So like that's pretty depressing. On a volume basis, from a dollar perspective, it wasn't as bad, but in terms of deal count, it's not happy reading. And deal count probably is more relevant to the level of market we're dealing with, as opposed to the mega billion sort of Wall Street type deals. So the context is tough. What you'll also notice, if you just jumping back a second, is that we've had down years since every years, and this is 25 year to date. We've had down years for this period each year for 5 years in a row, and I can't see that on other parts of this chart. So we all expected the Fed to reduce rates in June last year. That didn't happen until September. That obviously helped galvanize a bit of activity. Then there was uncertainty about the election. Then there was the whole tariff issue. But generally M&A rebounds, and I've been doing this since 2000, and I've seen rebound after the dot-com crash, rebound after the credit crunch, and it would be incredibly unlikely to keep seeing this. So whilst it's depressing reading, looking at these stats, it does, with a glass half full optimistic approach, look like we're going to hit the bottom. If not, we've already hit it. So what were the trends as we look at in terms of M&A for Q1? Again, 2-decade low. So there was nearly 7,000 deals announced in the quarter. There were a few mega deals in the back end of the quarter. So they obviously helped the numbers. Private equity exits are rising. The volume is rising. Dollar volume is rising, which is good. And specifically, there's some sectors that are doing better than others, technology and some sort of power, electricity areas. So that's the sort of the context. And we need to keep that in mind when we're thinking about valuations for this particular sector today. Okay, so I'd like to bring in Chris to speak, please. Chris is going to talk to Amazon agency trends. So over to you, Chris. The floor is yours.
Great. I'm having some technical difficulties today, so let me know if you can't hear me properly. Thank you for inviting me onto this webinar. It's a distinguished panel, and my partner Fortia has been great in tackling going forward, finding homes for these agencies. So I appreciate our partnership as well. What I wanted to do is, while the topic of this webinar is around digital agencies in general, I wanted to pick on a particular subset, and that would be the Amazon agency. In lieu of maybe not as great results for Q1, this is a sector where we're seeing a lot of heat, and it's my especially and Reach is kind of focusing on this and tracking these agencies, and we're seeing more activity in the space than ever before as agencies, brands, and others try to solve for solving for Amazon, if you will. And so one of the goals of InReach is to bring statistics to the space, the Amazon agency space. And so I've been tracking them quite a bit lately and have a pretty good breakdown of the landscape of Amazon agencies. You see here through the chart, there's about 600 Amazon agencies in existence in the world. The criteria for this are being really more than 3 people in a closet, 50% of the revenues around Amazon and the like. You can see the breakout with the majority obviously being in North America. And those around the world as well, in rough sizes. Next slide for me, Emmett. So actually, I think we missed. Yeah, there we go. So what we're seeing is the number of one of the interesting trends around Amazon agencies is that there was a creation of these agencies really around that modeled really the seller environment. And so with the boom of COVID and the explosion of Amazon agencies, we saw agencies being created from that seller environment. But what's interesting is that has fallen off over the last couple of years, and really the creation of new agencies is really down to a minimum here in the last couple of years. And what that means is that the set of Amazon agencies is really out there right now. The players are set, and therefore the evaluations are up a little bit as well. Real quick on some forecasting, we projected out that roughly the size and total revenue, the TAM of the space, and the total employees that are involved in this. It is growing space, and even with the economy and tariffs and the like, we anticipate this kind of growth. Next slide. So what does an average Amazon agency look like? Really, they're crossing around 5 million in revenue. Most of these are about 40-50% margins, so you're looking at about 2.5 in EBITDA, around 30 employees or so, and mostly focused on Amazon, but may have TikTok and some other capabilities as well. And the multiples we're seeing there is around 4 to 6x in this space. Next. So I've broken that out really into 4 buckets. There's tiny, small, medium, and large agencies. Keep in mind that this is the Amazon agency world. So the largest agency in the space is really crossing 20, with a few exceptions, around 25 million in revenue and 250 employees. The smallest, again, being 3 employees in a closet. So a tiny agency right now, of which we're seeing about 300 global agencies out there, 3 to 10 employees is around 1 million revenue, and about half that in EBITDA again. We're seeing around 2x multiples for that. The next stage, or the next step up, the next bucket really being small, around 200 agencies, 10 to 50 employees, crossing 5 million, and again, about half that in EBITDA. We're seeing 2 to 4x. The next bucket, about 4 to 6x, again, halving down the number of agencies in existence. Really only talking about 100 agencies in this that fit this criteria. And the last one, really a couple dozen agencies that have crossed into that 6 to 8x multiples. We'll have some back and forth on whether we feel that's accurate. I'm on the lower end, I'm told, but for the most part, we're looking at around 6 to 8x for the largest Amazon agencies in the space. Next. And then lastly here, one of the things I pride myself on is sort of projecting out where the evaluations are going for Amazon agencies. And I really predicted 2 paths forward, really an optimistic and a pessimistic scenario. And this is a reaction to really the last 3 months of the economy, the really last 3 weeks of the tariffs that are affecting agencies, affecting their brands, and will eventually be trickling down to the agencies. And so there is the path that we were on, which was an optimistic scenario for valuations, continue to rise at a steady pace going forward for the next 5 years or so, despite all the pressures. But there is a pessimistic thing where we may be seeing a fall in those evaluations, again, due to the economy, fewer buyers, some pressures, again, respect to tariffs and AI and some other pressures, hiring, and things like that. There is a pessimistic scenario where we actually in 2025, we actually start to see a fall in those evaluations. And so where I think we put this, just to wrap up my section here, where I think we're at right now is sort of a mid-road right there with the new announcements of possibly a deal with China, possibly some other pressures coming off. So I think we're maybe more on that optimistic path than the pessimistic. Thank you.
Great. Thank you very much, Chris. And thank you, Mike McFadden, for the first question. Panelists, please feel free to answer that question as we go through the deck. So that's agency trends specifically, obviously for Amazon. That's Chris's expertise. Let's jump now to public market comparables. Again, like there are very small number of concentrated aggregators, if you will, or roll-ups, WPP. How many firms has that bought over the years with back to Sir Martin Sorrell's days? This is just to take a quick proxy. If you look at the PE ratios of what they're trading at today, it ranges between 10 and 14 times price earnings ratio. The share price of most of these leading firms has declined by quite a significant amount, 10 to 16% this year. I think Omnicom is down over 20% over a 12-month period. So the context is that these groups, I know they're large behemoths, but they're trading down year to date, which isn't incredibly helpful for valuations at the private level. I thought this was interesting, and obviously there's too much to present here, but this is a UBS note on Omnicom that was published a few weeks ago. It's interesting to see the commentary, and as part of the follow-up, you'll get this PDF so you can go through that at your leisure. But it's interesting to see, and we'll get more sophisticated in our next webinar on getting more data to you regarding the valuations of all these listed comps and get more research from other banks on it. Okay, so let's get more micro now into the sectors where you're all working in digital agencies. So we have two talks, one from Tom first, and then Seawalk from Barrel Holdings. So I'd like to invite Tom to the floor. Actually, just let me present one side. Excuse me, Tom. So I wanted to give some context. I found some good data from PitchBook and a firm called Jahani and Associates, which shows deal count specifically in the agency space since 2020. And you can see that deal count is at a effectively a 5-year low. I don't have data going back, so that sort of matches what we're seeing at the macro global level. Deal volume though is increasing, which also matches what we're seeing at the global level. So the deal count may be coming down, the volumes are increasing. The other point I'm highlighting here is that H2 2024 was significantly better than H1 2024, so that's a positive. So I would think that from here, hopefully, the next time we show you these data points, we'll see a bounce. But let's hear from two people that are fully in the middle of acquiring businesses in this space. So over to you, Tom.
Okay, I appreciate it. We're going to be going through, first of all, Emmett, thanks for the invitation. Excited to be here. We're going to go through some rapid fire just information, and what I'm hoping for is for a paradigm shift for those that are listening, whether you're looking to scale your business and looking at valuations for what the current market is, or option 2, which is you're planning on an exit, whether it's over the next 12 months, 24, 36, or 48 months, some different ways to look at it from a CEO perspective. Next. Okay, so ultimately is what is your goals and what is your dreams for your business? And that's what you really have to anchor into. And next, Emmett. every CEO has our responsibility is not only to provide the direction for our businesses and to take the direction into plans and convert that into energy and momentum for our teams, but it's also to find ways to leverage the resources we have. Some of the key leverages we as founders and CEOs know we have is obviously it's our current platform, it's technology, it's people. The other key thing to look at, and again, when I say technology, it includes, of course, AI, but the other key lever that every CEO should be thinking about is M&A and how I can leverage acquisition to solve my discount factors. Now, we're not going to spend any time really today, or I won't, on discount factors, but basically is as I look to acquire companies, and so far I've acquired and exited 16 business, and I'm active in the space as well as working with over 100 businesses they're actually actively acquiring. And so what I see is that we always typically we like to see solid growing businesses, and that's where we gave our multiple ranges on it. And you can be on the range upper or lower depending on the scale and the stability and the predictability of the business. But there are a large number of things of discount factors, the reason why you won't achieve that range, whether it's concentration risk, and again, it is what you outsource versus what you have internally, but everything ultimately results in predictability. But one of the biggest ways that you can actually jump and enjoy multiple arbitrage, which is having a higher multiple for your business and to get on the higher range, is by showing growth through acquisitions and having acquisition solve some of those discount factor, including concentration risk. We'll talk about that in a minute. Next. Okay, so what if I can show you a way that if your exit horizon was 5 years and you can compress this, obviously shorter, we can actually 10 to 20x your current value. And that's the power of acquisitions. And we're going to go through the math on that in a minute. But I want you to think about acquisitions as not only solving almost every strategic issue, and I'm going to give you a quick example on that. So we can go next, would be great. Okay, and just a quick background on acquisitions for me is my first acquisition was 25 years ago. My first business, T-Shipley Catalog, we mailed out millions of catalogs. It was an online store, a dozen-page in SkyMall magazine. When the recession hit after the dot-com bust, we needed cash, couldn't make payroll. An investment banker out of New York called me up, and he queued up for me to acquire a business that was twice my size. So again, we were triple the size at the end of it, even though we had no cash. And it was a division of Boise Cascade that was spinning off a division that was spinning off a division from that. But it was perfect size for us. It solved a lot of the challenges we had and created a solid opportunity a year later for an exit. So, and that was my first experience, having no experience in acquisitions, not knowing how to do it, as well as how do you do it with no money? And again, there are ways to do deal constructs where you don't need cash out of your pocket and resources to do it. Next slide, please. The next challenge is fast forward 3 years later, we had a skincare business. We grew it to $331,000 to prove that you can, that using direct response marketing, you can build iconic beauty brands. Everyone said we failed in 2005, it would never happen, but we ran out of money. What do you do when you run out of money? I learned it from my first business. You buy a business, because our problem is that we had so many challenges, no CRM, manual processes. We didn't have a lot of experience in digital. We had no team. You name it, we had a challenge, and we didn't have cash flow. And at this point, for a business doing $331,000 in revenue and losing money, you're not going to be able to raise money. At least we couldn't. And so what did? We bought a business. Next slide, please. And so what we did is we bought a $15 million business out of Hoboken, New Jersey, doing $1.5 million of EBITDA, but they were a strong online business. And so this gave us everything we needed in the platform, which solved what I call discount factor, or our challenges in the business, from team, infrastructure, CRM, funnel capability, speed. And so with that, we put our skincare brand of $331,000 on this platform. And within 3 years, we did $100 million on that little $331,000 skincare brand. We did over $1 billion of revenue over its lifetime. Next slide, please. It's the power of acquisitions in solving problems. So that really where that is. And then we used in that platform, we had other brands such as Christie Brinkley Beauty, Keranique, the leader in women's hair regrowth. And we exited that business in 21 to private equity. Next slide, please. So, and this is basically the math, the way that happened, year by year growth. But the key thing here, it was we had to solve all the challenges we had of capabilities and also cash flow. And remember, we had no money. We were out of money personally, and the business was losing money. We were able to bring in outside capital because we bought a growing business and we brought in mezzanine capital in order to do that acquisitions. So it doesn't mean that we didn't buy the business with no money. It was just none of our money because we were out of resources. So there are creative ways of doing with no cash, low cash and doing deal structures, but that's a conversation for another day. Next slide, please. And so acquisitions can change your trajectory. And one final slide I want you to see here. Next slide, please. Is okay. Remember when I said you can 10 or 20 exit in 5 years. And let's assume you have a 10% growth rate a year is what your organic growth. If your rule of thumb is every year I'm going to buy a business that is half of my current run rate. You do this with nothing crazy. You don't have to set up a model where you're doing 3 acquisitions a month. If you do 1 per year for 5 years, what's going to happen is your EBITDA is going to grow proportionally what you buy. And then also the multiple expansion, what you're going to actually get for that is also going to expand from, as we saw in the prior charts, from what would be 2.5x at $500,000 of EBITDA to at a 4 million EBITDA as your growing strong business, a 6 times multiple. And again, that's how you get there. So what I want, hoping that you'll leave with is that it doesn't matter the resources you have. It's all about resourcefulness. Acquisitions can solve almost every business challenge you have, especially when you have your eye on an exit or strategic alternatives, or you want to become that platform for growth for private equity and continuing acquisitions. That you doing acquisitions this year, and I believe opportunistically, 2025 is the year to do acquisitions. It also gives you the scale for also implementing technology like AI. Thank you.
Great. I welcome Barrow to the floor.
All right.
Ewok, yeah.
Thanks, Emmett. Yeah. All right, great. Can you hear me? All right.
I didn't hear.
All right. Okay, great. I'm Sewuk, co-founder of Barrel Holdings. Love to share how we think about valuations and underwrite deals from a long-term owner perspective. Next slide, please. So we are a holding company of specialized agencies across platforms like Shopify, Webflow, services like brand and product design, verticals like Amazon. My co-founder Peter and I were agency operators, ran our first agency, Barrel, for over 18 years. We still own it. So really with the holding company, we are acquiring, managing, and launching companies with a long-term mindset. So we are buying to hold, so we're not buying to flip. So we hold for cash flow. So our focus is really building durable cash flowing businesses with great operators and supporting them at the holdco with shared services. Next slide, please. So our strategy for M&A is growing through acquiring standalone companies, keeping existing brands, or doing tuck-ins to our existing portfolio. Our focus is businesses typically in the 2 to 10 million revenue range, ideally over 15% EBIT, strong leadership team, diversified client base, and a niche focus. Next slide. And when we think about valuations, multiples are really our starting point. Say most of our deals fall in a 2 to 5x EBITDA range. And what we pay really depends on the fundamentals of the business. Things that we value here, so recurring revenue, scalable sales engine, low client concentration, and then teams that really operate without the heavy founder involvement and the specialization. At the same time, we do consider less conventional deals, so thinking about agencies that have low margins or declining revenue, and really where we can look and see a path to profitability with these businesses. And also thinking about flexible seller goals. So speed to close is important. You have unique partner dynamics. So really open to deals in this range. We're typically using debt to finance our acquisitions. So operating stability, performance stability is important. And obviously interest rates affect our valuations. Next slide, please. So really our valuation comes down to modeling cash flow, because the value that we're deriving is cash flow versus exits. So we look at factors like levered free cash flow, cash on cash return, payback period, with specific targets for each of these. And next slide. And yeah, when we're trying to make deals work, we're structuring creatively, trying to align incentives with seller goals. So this could be a combination of cash at close, seller notes, profit share, equity rollovers, and these things, especially when there's a shared upside, can take a deal beyond a 2 to 5x multiple that we're looking at. So yeah, let me take a look at share three case studies. The first case study here, deal one, founder wanted a quick transition. So this is a business that the seller was going through another acquisition process that failed after several months. So they had some deal fatigue. What we offered was a quick close, cash up front, and worked on getting the founder out of the business as quick as possible and a new CEO in. So this one, I would say, lower end of the multiple spectrum. On the second deal, really it's about long-term alignment. The seller wanted to roll as much value into the future with us. So we structured this as a cash at close, seller note, but most of the value was captured in the equity in the new entity as well as ongoing profit share. And in the third deal here is all about cash up front. We value this deal at 5x EBITDA with 90% cash up front, 10% as a seller note, and added a 5-year profit share kicker. And this was all about having a strong leadership team in place and clear platform specialization and expertise there that we thought the value was worth the multiple. So yeah, in general, there are a lot of ways to structure deals, and the way that we look at it is, really taking a long-term view. We're starting with multiples as the framework, but the deal ends up being a lot more about cash flow for us, leadership team, structure, and yeah, happy to be a thought partner for anyone who's exploring a transition.
Thank you, Siwok, particularly for those practical examples. And yeah, it's interesting that you can have valuation range, but terms and making those bespoke to the individual situations of founders is key.
Yeah.
Thank you very much for your time. Okay, so now I'll invite my colleague David, who's substituting in for Paul, to discuss the types of metrics that acquirers are seeking. David, over to you.
Good afternoon, good morning. So as we start to think about agency metrics and how they impact the valuation of your business, we like to take an acquirer's lens. A key part of what we do at Fortia Group is really understand what an acquirer wants, and then turn that lens on your business to help you understand, what are the key things, the key metrics that will actually impact the valuation. On to the next slide, please. So we've broken down metrics into 5 clear areas. Obviously, predictable profitability. So when we talk about your EBITDA size and your EBITDA margins, it's important to also think about, is that profitability consistent? Can you show similar margins over the last 12 months, prior years, or does it jump up and down? Because from a buyer perspective, inconsistent profit margins that may jump up or down, you may have losses certain months, are essentially sometimes a red flag. Obviously, profitability in an agency business all starts with your cost of service, because after your cost of service to provide the service to your clients, you need to look at the margin that you actually can contribute to the rest of the business for your fixed and variable costs. As we start to look at revenue, we need to understand what's the defensible revenue. All M&A transactions tend to start with a financial model. Defensible revenue, recurring revenue enables you to model it on a much more consistent basis than not. With defensible revenue, obviously, what percentage of your revenue is recurring? What percentage of that is retainers versus subscriptions? Subscriptions obviously can often provide much higher margin than actual retainers alone. We also want to look at your revenue mix. What's recurring versus project-based? What kind of contracts do you have in place? What are the structure of those contracts? What's the length? What are the renewal rates of those contracts? How long have you had clients within your portfolio? Long-term contracts, high renewal rates, all add to your valuation. Agencies that have, just project-based revenue often attract lower margins than those that have an element of recurring. As we start to look at your client portfolio, what's your client risk mitigation? Is your business dependent on any one client? All agency business tends to start with their first client, and how has that relationship evolved? The rule of thumb when it comes to sort of valuation is you don't really want any one client being more than 10% of your revenue. Sometimes that's unavoidable because you've taken on an account and it's just grown. However, you don't really want your top 3 to 5 clients being more than 40% of your revenue, and so on and so on. So it's almost the antithesis to the Pareto 80-20 rule. Low churn and long-term client relationships are also key. If you can really demonstrate that clients are continuing to give you their business and show that they trust you, is key. We often look, the next lens we sort of look at is the scalable operations. Say we mentioned, the owners. Some owners want an exit straight away, someone to remain in the business and become part of that journey. If the owner is such a key man to the business, often that can be a challenge for a potential acquirer, because without that key man in place, how will the business evolve? Is there a good team underneath the owner? Does that management team have the experience to help to grow that business if the owner does leave? Are the processes within the business documented? If you 2x your revenue tomorrow, would you have to 2x your cost base just to serve that additional revenue? And also, what are your staff utilization rates? What are your bill versus non-bill hours when it comes to your staff? In a lot of situations, if you're working off fixed price contracts, you really need to think about that margin. Is that margin maintained throughout the length of that contract, or is there leakage? Then we look at the market differentiation. What makes your agency different to all the others? Do you have any particular niches that you serve? Is there any vertical specialization? Because obviously that makes you attractive to an acquirer who's looking for vertical expertise. What's your brand reputation? Do you have good client testimonials? Have you received any awards? Clear USPs, strong niche, all adds to the valuation. Another thing you need to look at is, the buzzword at the moment is AI. Are you using AI? Are you truly using it, or are you using an element of ChatGPT? If you're making claims about using AI, make sure it's defensible. Commercial due diligence we're seeing at the moment is really focused on those key pieces. Is it helping you reduce costs? Is it making your team more efficient? So what's the impact of that on the business? Next slide, please. So we work with our clients to not just help them understand their business and the value of their business, but we also want to give them exposure to acquirers. So we've created a new process, a new product essentially, that is acquirer-led feedback. So we're working with clients over a 3-month defined period of time, and we want to help them to understand, to create a teaser around their business, outline what are the key metrics that drive value for the business. Then we connect them with the acquirers. The concept is that the acquirers will essentially give feedback. All M&A transactions have to start with a relationship. They have to start with conversations. So acquirers are open to meeting businesses early, even if you don't plan to exit 12, 24 months down the line. Emmett referenced the flirt, date, marry approach. This is very much the early stage of that. We're flirting with these businesses. But one of the benefits of that is we're getting feedback from the acquirers. They will tell you, what are the things that they are looking for within the business, and do your metrics align to what they say. So that's an incredibly powerful source of feedback to your business. That's not a consultant standing on the outside looking in. That is someone who could potentially buy your business, telling you how things need to be structured to move that forward. All that information then we distill into a very good report. That report can then be taken and implemented, enabling you to take those insights and deploy them to your business. Thank you.
Great, thank you, David. So section 6 of 7. So we'll go to deal dynamics. It's important to think about, dynamics and how they affect valuation. For example, a seller may have to sell by a certain period of time, or we've seen deals where buyers have to do a deal by a certain period of time to help them raise more funds. So it's something that is often not thought about, overlooked. So we welcome Carrie to the floor to discuss her thoughts on getting an exit ready, and also some deal dynamic experiences from her background. Over to you, Carrie.
Thank you, Emmett. So a couple things. First of all, I love that offering from the Fortia Group. That is an awesome offering that they just talked about, because I think it's really wonderful to be able to spend some time shaping your narrative and getting feedback on it. So as we mentioned, I'm Carrie, and I built, scaled, and sold one of the first social media agencies. I started it in 2007, bootstrapped it through 2021 together with my husband, and we grew it to 60 people out of New York, one of the best places to work in New York. And we ultimately sold it in 2021, which, if you looked at that chart before, was the magical year of exits. It was a nutty and wild year. When we sold the business, my husband had already moved on to launch our next business, a tech company. And so I was in the process of going through that sale, and recognized that even though I thought I was prepared, there was a lot that not only I didn't know, but just sort of like wasn't ready for. And especially as a woman in the space, I looked for women like me who had sold their businesses and found that they were very few and far between. And so I decided that in my next act, I was going to focus on helping business owners get really exit ready. And that means we're going to anticipate some of the deal dynamics that can happen. The reality that you'll hear about, both on the buy side and sell side, whether you're buying or selling, is that half of these deals that you are going to put your heart and soul into, whether you're selling a company or you fall madly in love with a company and you want to buy it and it's like perfect for your portfolio, half of them don't close. Okay. And there are a lot of reasons that they don't. And my job, and the reason I'm here today, is to help you understand some of those dynamics and how, if you are a seller, you can really prep yourself to get across the finish line. And if you are a buyer, how you can prep yourself to ensure that you are building the best possible outcome. So my methodology is called the Whisper Way. It's a methodology for a happy, healthy exit. And by the way, a happy, healthy acquisition. And I have a pretty bad memory. And so the way that I solve all of these problems in life is to build acronyms. And Whisper is my acronym for building a highly sellable business. And I'm going to relate it today for you to some of the dynamics that go through deals. Now, the first part of a reason a deal doesn't close, or a reason a deal closes for less, or really all of it, is linked to why. Now, on the sell side, this could be, I want to sell for $100 million, and that's in my head. And if I ask you why, you don't necessarily know. It's a big number. It's 9 figures. It sounds fancy and great, but it's unrealistic based off of where you are, right? So often deals don't close because sellers have unrealistic expectations, and they understand like why they want to do it, but they don't really match that up with reality. Similarly, another why could be, I got to get the heck out of here. Like, I'm done. I'm tired. I'm exhausted. And that kind of why is a pressure-based why. Divorce is a why. Disability, getting sick is a why. These are all really hard whys. And then there are really good whys too, which are, you know what? I've built this business and I've taken it as far as I can go, and I'm not like dead inside yet. I still have something to offer to an acquirer. But you know, I think we could do more with some help. Like that's like an ideal type of why. So understanding not your why for existing, but like why you want to go into this process. If you know that up front, you are much more likely going to be able to have a deal that meets that need. It was one of the speakers earlier was talking about different case studies based off of why, you know, the types of offers they give. And often that's the sign of a great acquirer because it's built on the seller's why. Similarly with acquisitions, you know, when Tom is so inspiring when he talks about growth through acquisition, every time he does it, I'm like, I need to go buy 100 businesses. That's what I really want to do. And I truly think it is a way to unlock growth. At the same time, I want to make sure that I understand why I am buying the businesses that I'm buying and is it going to integrate. And getting really, really clear upfront is going to avoid that last minute panic where the deal doesn't go through. Okay, so first it's understanding whether you are a buyer or a seller. Why do you want to do this deal? What motivates you? Removing all ego from the equation, just like the true getting to the root of the why. The second piece is the how, and that's understanding the multiples. Okay, so as I said, a lot of these things don't go through due to unrealistic expectations on either side. On the buy side, it could be, I want no cash up front. And the sell side is like, oh, no, I need all the cash up front. So a lot of times that's where we get caught. And understanding the market multiples, going to webinars like this, looking at industry data is essential. That doesn't mean that you can't build a business that soars past that industry data. You can. It is possible to be the exception and not the rule, but mostly we want to have an understanding of the rules. Now, again, we have no control over the market multiple range. That is data that is reported. You just saw a bunch of it. Where we fall within that range, we have some control over because we can build businesses that get us to a higher end of a multiple because we will be ultimately much more desirable. Understanding that market multiple before you go in and having a realistic expectation is going to avoid wasting a lot of time and a lot of money on both sides. The next part of Whisper is income. And the last speaker before me just talked about this. I like to talk about this. You know how we like our income in the black, right? We never want it in the red. When once again, with my memory, I have to create it so that it's memorable. I want my income to be red, meaning I want it to be recurring. I want it to be expected. I'm able to forecast it with ease. And I want it to be diversified. So low client concentration risk. I'm able to forecast not just pie in the sky. I mean, every single agency owner that I've ever spoken to, and I've lived this, is like, oh my God, this year, it's the year. Like, I know last year, here's our closed books, but like this year, we're really gonna do it. And like, it has to be able to be predictable, and you have to be able to show that that's going to happen. So you want your income to be recurring, expected, and diversified. And here's the thing about the income. It's not all created equal. It depends on how diversified you are. And the other piece of this, you guys, when I have sellers come to me and they're crying and they're like dead inside and they're ready to sell. They're like, I want to sell. I'm like ready to go. Get me out. And they're selling in a down year. I almost always try to get them in a space where they are ready to sell in a growth year. Because selling in a down year of income, it puts you in a position of weakness that you don't need to be in. Now, granted, if your why is you have to get out right now, that's okay. Then we adjust and accept that. But we need to know that selling in the growth year is going to be significantly better for you, especially from a negotiating standpoint, than it is selling in a down year. It's going to create a reasonable expectation for you and be in a great space. The S is secret sauce. And I always talk about secret sauce. Like when I weight these, it's income and profit are, of course, the most in terms of how we're valued. But secret sauce is what can take you well beyond any multiple range. This is just how badly they want you and what the strategic initiative is. What makes you different? What is your moat? So when I was with Likeable, which was the social media agency we founded, the way that I found this, because with agencies, how hard is this, right? We just say, it's the people, that's our secret sauce. But like the reality is we all have good people. So I surveyed our customers and I surveyed our employees and I said, what makes this different? What makes you want to work here? All of the different questions. And then I looked at my competitors' positionings. And what I found was that Likeable offered faster service because we had to be fast because we were in social. From the smartest in social, we only did social media and that was all we lived and breathed. So we were real experts, nuanced experts in that space. And our name was Likeable. So it was with likability guaranteed. And I measured that on Net Promoter Score. So what I did was I took what made us different and I did a biannual survey to measure it. So when I took myself to market, I was like, listen, clients hire us because we are faster and I can prove it. Here, look at all this data. It says we're faster than all the other agencies they've ever worked with. We are the smartest in social. We're their go-to. We fill that strategic niche if you're looking for it. And with likability guaranteed led to retention. And so being able to show that was really important. The last three pieces were profit, making sure that your profit is strong, very, very strong. You want to make sure that your profit is really ultimately we're measured on EBITDA. Don't get complacent with this, you guys. When I had a business that was over $2 million in EBITDA, I still forced myself to go through the credit card sometimes and look for extra subscriptions because every dollar at that time was worth $8. And so if I just kept saying to myself, every dollar's worth $8, I looked at what can I save that won't really hurt the business, going forward. Like, in other words, I wanted to keep my staff, but I wanted to make sure that I was run lean.
1 minute, please, Carrie.
Yes. What's that? 1 minute?
Yes, please. Yeah, thank you.
You're good. The executive team is really making sure that you have a team that's beyond you. Deals fall because they realize that the business is totally founder-led. Not great. And then the last piece is just really the roar factor, your ability to defend your business under fire, because that's what due diligence actually is. Businesses fail in due diligence because we are not properly prepared. We don't have our stuff together. We don't have it ready to go. And that is what we need to be able to really make sure that we have a business that is able to get across the finish line. And so these are just some of the deal dynamics that go through. It gets very difficult when you're in the last stages of due diligence, but making sure that you remember the end goal in mind, which is to work together, build something better, and make an acquisition happen. That's really your goal. So that's the Whisper Score.
Thank you, Carrie. Really like the acronym and your energy. Well done. Okay, we've a few minutes left, so I'm going to race through valuation. Ultimately, I'm going to show you our range, but to do that, we're going to look at some other inputs. We've discussed this before with Chris. This is his data presented in a different way. Essentially, for Amazon-specific agencies, what we're seeing from Chris's experience is that for businesses with 1 to 5 million EBITDA, they're trading at between 4 and 6 times. And for larger businesses trading, with 5 to 10 million EBITDA, they're trading at 6 to 8 times. So that's one data point we need to take into account. I asked Tom for his views, and he sent me this great table. Obviously, you can see that it scales depending on the EBITDA, and of course, as he said in the note or in the strap line, there's always a trade-off between price and terms, whether you want more upfront or less upfront, as we saw through the examples that Saybook showed. I asked Carrie for her views and her thoughts on valuation. We see for very small businesses, it's 2.5 to 5 times. For 1 million to 5 million EBITDA, it's 4 to 8. For larger ones, over 5 million EBITDA, it can be as high as 11 times. And I'll bring all these together in a simple schema in a moment. I did lots of research, and we found some interesting stats from DAB, which was showing based on revenue and net margin where rates should go as opposed to just purely sized based. So please take a look at those in the follow-up. Two other sources, agencies.co, they have EBITDA multiples at 4.5 to 5.5 for small, 6.1 to 8.2 for medium, and 8.1 to 10.6 for larger agencies. And we saw actually very similar multiples from another source called Capital A. So we've taken all that data point into consideration when we come up with our own range. As a recap to all the factors, all the ingredients that go into valuation in our view, it's the macro items like global M&A activity, it's the sector items like agency trends, public market comps, agency deal flow, agency metrics, deal dynamics. Some of those are outside of one's control that Carrie talked about. Some of them are obviously inside one's control. All those factors are important to think about valuation. So we have a scorecard that we've done for today. We'll do this on our next webinar in 6 months' time. So going through each of those 6 factors, global M&A activity, I'm honestly going as low as 1. We're at a 20-year low Q1 in terms of deal count, right? It's pretty tough scenario. Agency trends are going pretty well. A lot of agencies are doing well, so we've given that a 6. Public market comps, the Omnicom is down 20% over the last 12 months, so it's pretty soft there. We give it a 5. Agency M&A activity is plenty of deals happening, which is encouraging. We can discuss some of the reasons as to why that's happening, whether there's a threat of AI and so on. But there are lots of deals getting done, which is great. Agency metrics. A lot of agencies doing well in terms of the metrics that acquirers are looking for, and deal dynamics. To some of the points that Carrie is looking for, the reason I've given it an 8 is there are lots of acquirers interested in doing acquisitions. In the e-commerce space, for example, right now there are not. Frankly, there are not. It's quite tough for e-commerce brands, but for agencies there are. So we've given that quite a high score. Overall, our score today is 33 out of 60. I don't think it's going to be lower the next time we meet in November. So that's the score. So what does that mean for actual valuations? So we split this into 3 color codes: small agencies, that should say medium agencies in the middle, and large at the upper end. So we've summarized the viewpoints of Enreach. Obviously, again, that's for Amazon agencies, where Tom sees valuations, Barrel, Carrie, agencies, Capital A, and ourselves. So Fortia, for the smaller agencies, we think that we can go from a range of 3 to 6 times. That's where we genuinely think is fair. To Carrie's point, the real work is how do you get towards the upper end of that range? And to me, and to what David was saying earlier, a lot of it goes down to preparation and having your ducks in a row, following a flirt, date, marry process, so that you become as buyable as possible. Don't just start a process in 3 months' time without actually having systematically spoken to a lot of acquirers. If we look at the medium size agencies, Enreach had 4 to 6. Tom, higher, I think it was 5.5 to 7.5 roughly. This isn't Barrel's market, so say Wook didn't quote here. Carrie was going to 4 to 8. Agencies, Capital A, were up at sort of 6 to 8. And Fortia, we're saying the range is approximately 5 to 8 times. So again, if you want to be in the 8x range there, you've got to start work, as far out as you can. We've gone to 5, a little bit lower than some of the other comparables, because if growth is flat or declining, or there's issues with tariffs for some of the underlying brands, then it may be harder to get towards the higher end of that multiple. And we're nearly at time. So just to finish, for the large agencies, so we go from everything from 6x all the way up to 11x. We think we've given a range of 8x to 11x, which is in line with a lot of other firms. And again, to strive for that, it's all about a lot of the things discussed here: low concentration risk, high growth, recurring revenue, etc. A lot of prep. So hopefully that's helpful. Again, the PDF and the recording of this will be made available to you all. We don't have time for questions. For those that are able to stay on, please do. I want to ask each of the speakers to give one key takeaway regarding valuations as they look ahead into 2025, the rest of 25. So maybe if we could start with Chris, then we'll do Tom, Wook, and Carrie.
Again, thank you for the opportunity to be here. I think the biggest factor to valuations is going to be the economy in the short term, and then ultimately how your agency navigates AI, how it transforms it internally as far as your employees and your capabilities, what you bring to the table as far as an acquirer. Do you solve for AI for that acquirer, and things along those lines. So all things equal, and everything that's been presented here is dead on as far as evaluating a business. All those things equal, I think those are the two big evaluation pressures right now on agencies.
Thank you, Chris. Tom?
I'm going to predict more for 25 than 26 because I don't know. But from a 25 perspective, I'm seeing that valuations are from the agency space are are remaining fairly surprisingly stable. Yes, but you have to look at sectors. If your specialization is e-com and that's what you're buying at, that's where it's a little more challenged right now because of what's happening with customer bases. People are losing clients because clients are pulling back. That's the most challenging sector. Other than that, I'm seeing stability there. Long-term wise, AI is a factor that's going to impact it, and as Chris said, the market.
Thank you, Tom. Siwuk.
I'll agree with all the terms shared here. I would say definitely, yeah, overall macro conditions, especially with tariffs and how that affects client contracts from an agency perspective. But yeah, one of the things to maximize just thinking about specialization and looking at the opportunities of when to sell. So when your agency is on an upward trend, I think definitely would help in your valuations.
Very good. And Carrie, to finish.
Yep. What goes down must come up. Loved seeing the trend of M&A going downward. I would suggest you hold on, you invest in becoming AI enabled, you work hard in your business, and then get ready to go because it's going to go back up.
But thank you to all our speakers for participating today. Really great content, both in physical form and our audio and the content. And this is our first of hopefully many over the next coming years. So look, welcome any feedback you have to make this better for the webinar we'll do in November. So thank you again. Have a super day. Bye-bye.